Hey guys, this is Tim Picciott with World Alternative Media, also joined by John Sneisen. And today we're going to talk about what is going to be the catalyst for the next Big Short. Now, a lot of you guys probably love the movie, The Big Short. If you haven't seen it, I highly, highly, highly recommend it. It was one of my favorite movies. I think I paid for like 20, 30 people to go see it at a client event. But Dr. Michael Burry of The Big Short says he has found the next market bubble. And what he's talking about in terms of market bubbles are passive investments are inflating stock and bond prices in a similar way that collateralized debt obligations or CDOs did for some prime mortgages more than 10 years ago, Burry told Bloomberg News. Like most bubbles, the longer it goes on, the worse the crash will be, said Burry. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally, he then goes on to say. And what we've seen is that this, it's going to have a very big catalyst for when, to help have the market go up, but also it's going to lead to have a quicker downfall when the market inevitably goes down. And basically, the longer this goes on, the worse it's going to be. And you even got guys like Jeffrey Gundlach of Double Line Capital said that this creates a herding behavior, and right now it's reaching a mania status. Now he also goes on in another article to say, and let me pull up this article over here from Zero Hedge, but he goes on to say, in the Russell 2000 index, for instance, the vast majority of stocks are lower volume, lower value traded stocks. Today, I counted 1,049 stocks that traded less than 5 million in value during the day. That is over half, and almost half of those, 456 stocks, traded less than 1 million during the day. Yet through indexation and passive investing, hundreds of billions are linked to the stocks like this. The S&P 500 is no different. The index contains the world's largest stocks, but still 266 stocks, over half, traded under $150 million today. That sounds like a lot, but trillions of dollars in assets globally are indexed to these investments. The theater keeps getting more crowded. Okay, we already said that quote. And in the end, this is not going to end well. Potentially making it worse will be the impossibility of unwinding the derivatives and naked buy/sell strategies used to help so many of these pseudo match flows and prices each and every day. This fundamental concept is the same one that resulted in the market meltdowns in 2008. However, I just don't know what the timeline will be. Like most bubbles, the longer it goes on, the worse the crash will be. And what he means by indexing to let's say like the S&P 500 is a lot of times these big funds, and I'm not going to name any, they don't actually have that underlying stock. What they have is a derivative tied to the stock. And so really eventually when you are trying to, when the music stops, you're looking for a chair, you need to make sure that you still have a chair. And so what do you think, John, when it comes to, passive investing and how people are just, pouring into things willy-nilly, and ultimately the effect that that's going to have on the next market downturn that we see?
Well, the problem is that we see a lot of the, this inflow into ETFs. It's become extremely popular, and of course, that is a derivative of the real thing. And depending on how much underlying assets you have in that ETF pool that you're investing in, now you could be in the same risk as you are with gold and silver, where you're looking at over 200 contracts to one physical metal. If you go and run for the doors, only 1 out of 200 guys will get the physical metal. And people don't really understand the risk of derivatizing everything that you're looking at, and especially in the stock market and commodities and so on. You're making it available for people to commit those frauds by outputting a lot more, basically creating a printing scheme like we have with our current fiat currency system, and you're making it available for people to commit those scams. These big fund managers, they could create more and more and more ETFs as the demand is there, but still you might have the same amount of assets if there's any back in them. So that is the risk that you will see in those funds, and I see that as a solid risk. It's definitely something that, like, who actually owns what, and we could only look at Japan and see how they actually bailed out most of their ETFs. The Japanese, the Bank of Japan owns 86.11% of all the ETFs because they had to bail them out. They were failing. Are we going to see something similar here? Potentially, as we see, the guy that wrote the Big Short here, the main guy that saw what was happening in 2008 and bet against it. in about 2006. He's seeing the same thing again with ETFs there potentially. And as I said, Japan seems to have seen it already, where they actually had the central bank had to come in and buy up most of them because they were, overly crowded, as he was saying in his comment there. So I think that's a definite risk here, Tim, that you could see something like that happen, because any time you have a structure that you create where you could create more more assets than the underlying asset, it's a huge risk. And of course, it's very tempting for the companies and whoever creates these funds to create more, a little bit more, and a little bit more of these shares that they have in their fund that they might not have at all anywhere near the backing of physical assets in the background when people are running out of these funds and wanting to liquidate themselves.
Yeah, and you were so good because we didn't even really have too much of a pre-prep meeting, as you guys can see, that we were coming on here. And the very next thing that Dr. Michael Burry talks about is, ironically, and that's actually the word that starts off with, ironically, the Japanese central bank owning so much of the largest ETFs in Japan means that during a global panic that revokes existing dogma, the largest stocks in those indexes might be relatively protected versus the U.S. And the reason for that is just what John was going on and saying, is that if you have Japan going in there buying, and it's funny, I was going to ask you, I was trying to look up what the percentage was, and then boom, like Rain Man, you just go and give us the percentage as I'm going to look it up.
It might be slightly different now, but it was like that when me and Josh reported on it about
like
7 months ago or something.
Or maybe now it's 95, who knows.
But definitely it's around there, yeah.
But that distorts everything. And really what happened, if you take things back into 2014, October is when the Federal Reserve stopped printing money. And then about a couple weeks later, then the Bank of Japan massively starts printing money, and the Europeans massively start printing money. And it's like this hot potato that gets thrown around globally to see whose turn it is to bail out the system. And with Japan, owning all of these ETFs, people can, the only criticism, basically somebody could say of me is that I thought that things were going to crash a little while ago. But guess what? I didn't think we're going to have $17 trillion of negative interest rate bonds. I also didn't think that, when you do something, like, okay, you've got the Bank of Japan who just goes and just makes, 56 billion yen, worth of, or 56 billion US dollars worth of stock purchases in a year. Well, that's going to have a gigantic effect on the market. And what it is that is actual fascism. It's a point that I've been making for the past 4 years right now, is that people talk about, Antifa wants to talk, they're the ones who act like the fascists, calling everybody else fascist. Meanwhile, Bank of Japan, that is actual fascism, where you have the state, basically corporate ownership of the companies by having a central bank that purchases money out of thin air and then use that money to then buy up the assets, which is why you had, founding fathers of America say, if you ever allow a private central bank to issue the currency and credit of this nation, we'll all end up homeless on the continent our forefathers conquered. And this is exactly what is going on. But getting, it sort of got a little bit off track, because of me. But what all this is getting at is that when you see people who are going into, whether it's, the SPY, and I am a financial advisor, so I'm not making, this is not a financial advice. This is all for informational purposes because it's in the news, because if I get the SEC to look at this, then I need to make sure I hedge myself with that statement. But if you guys do need an advisor, you can head to thelibertyadvisor.com. But anyways, whether it's, Vanguard's, S&P 500 fund or Fidelity's or BlackRock's or whoever, State Street, you have tons and tons of people who are just putting all their money in their 401ks and IRAs into these vehicles. And so let's say you have $1,000 a month going in automatically, well, you're just buying up all those stocks, regardless of who the CEO is, regardless of what the earnings are, regardless of any of the information that's really out there, because you're just willy-nilly buying the market. And that then creates, positive feedback where people say, oh, the S&P has been the best performing asset of the past, X amount of years. Well, notwithstanding Bitcoin, and, it depends on a longer time horizon, like 20 years, actually gold is ahead of the S&P 500 as well. That's a whole nother subject. But I actually do agree with Dr. Michael Burry that this is creating this herding effect where, it is magnifying how good things are going on. And if you take a look at and we'll get into this in a little bit on the next report, but take a look at the earnings of the S&P 500, those earnings have dropped down like a rock since December 2018. But yet the stock market is up a lot since December 2018, because since the earnings were bad, it meant that now that the Fed has the excuse to cut rates, in this whole feedback loop of good news is bad news. And then if we take a look at actually the Russell 2000, so I'm going to try to pull this up right now from Morningstar. But if we take a look at the Russell 2000 right now, what we're actually seeing is that we have the market is down 11% over the course of 1 year. And what people that aren't as astute will say, okay, well, it was down 11 last year and it's up 13 this year, so it's up 2%. Well, no, if you're down 11, you've got to go up 22% to get back to even. And so the Russell 2000 represents the, core American, kind of everyday, smaller, mid-sized company. So the companies that fall outside the bounds of the S&P 500. And so wouldn't you expect that those would be, rocking and rolling at all-time highs if this is the greatest economy ever? And the reason the S&P is so high is because what we just talked about, all that money that is automatically going in there, creating all these artificial distortions. So I don't know if you've got too much more you want to add to that, or if you want to maybe start getting ready to wrap up on the next presentation.
Yeah, I think we're ready to wrap up there. But just one last comment is, of course, the Russell 2000 is more broader and more of the actual corporations in the United States than the the big 500. So you're looking at a more solid measurement, if you can call it, of the strength of the economy. Because what we got to remember, in an economy, it's not usually only the big corporations that drag it, that drive the economy. It's a lot of the small and medium-sized businesses. They are the ones that are the backbone usually of a real good economy, and we're seeing less and less of them. They're struggling because of corporate interference in governments trying to regulate industries, and what we see is it's getting harder and harder for others to come in and compete into those industries. So it's a definite showing of that the United States economy might not be doing as well as everybody's telling us. And of course, what we got to remember too, that makes the stock market and everything go up here, is because it's not that good everywhere else. A lot of economies around the world are really struggling, and what we're seeing is, of course, like in 2006-7, a big ramp up in the strength of the U.S. dollar because everybody's flooding to U.S. dollar-denominated assets. So what you're seeing is basically a fake strength coming out of the panic that's happening with debt markets around the world. The Canadian yield curve has been inverted like 25 basis points for the longest time. And of course, Deutsche Bank and others over in Europe are really struggling. You see negative interest rates, which is basically a default. So there's a lot of misallocated, if you can call it, excitement about the economy when we should be more cautious and actually look at the real numbers that are out there and thread a little bit more cautiously than be like, hurrah, hurrah, the US dollar is doing fantastic. The US economy is at the top of its peak. Meanwhile, there's an underlying severe weakness in the economy that mainstream media doesn't like to talk about too much, because they're of course owned by they get their revenue, advertiser revenue from those big corporations that are providing these funds.
Oh, sorry, I just realized I was muted. But anyways, this is, I think, definitely going to be a big catalyst the next time there is a big downturn. But what I do want to mention too is that one way you guys can help support John is he does have 2 outstanding books that he has written. So you guys can head over to Amazon for that. Let me pull it up on the screen right now. But one of them is The End of Freedom: How Our Monetary System Enslaves Us, The Prepper's Guide to Surviving the Economic Collapse. And then we also have Canada, the Greatest Economy in the World: The Facts You're Not Being Told About Your Money and How to Protect Yourself from Coming Crises. So
you forgot the question mark.
I'm like, I don't know, do I say the question mark or not? I wasn't sure if I was supposed to say that.
I'm just joking.
But if you guys type in John Sneisen's name in on a search engine around Amazon, you will be able to find that, and that is a way you guys can help support us. You got all the links that we'll have down below that how you can help support Josh. He's getting back to Vegas today, then heading to Anarchadelphia, then going back overseas, so to undisclosed location. And then one other quick plug for myself, I just got this website up as well. So if you go to libertyadvisorshow.com or the Liberty Advisor Show or basically all the places, all the roads like that lead you back to Rome, lead back to me. And what we're doing here is you can check out this through MP3 format on podcast. Check it out through links for DLive, which is our preferred live streaming, all the BitChute links, all the YouTube links, and then also have a link to my book that I have actually for free. Another way to get that is if you want to text Liberty Advisor, just one word. The number is 71441. So in the body of the message, just put Liberty Advisor, and you'll be sent my book for free. And basically, that book is on how they rig the inflation rate, the GDP data, the unemployment data, and I give tons of proof and examples. And don't just make claims that they rig it, but I show exactly how they do that. And originally, I wrote that to dispel everything that was going on with Obama, and now, unfortunately, I've got to use it to dispel what's going on with Trump. So
government.
So I'm Tim Picciott, and we've got John Sneisen with World Alternative Media. And until next time, find the truth.
Be the change.